over the last week in the S&P 500, the majority of companies are down significantly, and what this has led to, companies like McDonald's being pushed right towards their 52-week lows. Today we are going to look at 10 of them. We're going to talk about them very briefly, their historical performance. We'll take a look at each one of their rating summaries from the different analysts, and we'll have a quick overview of their dividend score. Is it safe, very safe, or maybe perhaps unsafe? And each one of these 10, we're going to give you our own intrinsic value. We'll give you our acceptable buy, incorporate that investor margin of safety, and also tell you what upside Wall Street has over the next year. Now, the first one, McDonald's, we do have a double buy rating from Seeking Alpha and Wall Street with a hold from Quant. As we said, each one of these right there towards their 52-week lows, and they have been punished over the last 12 months, down 15%. You could argue some of this is due to those Middle East boycotts, as well as their earnings, which wasn't that great in the latest quarter. And we can see this is a company that does offer a forward yield of 2.7%. a forward P of 20.49, and for those that want to know, the S&P sits around 22.5. Over the last 10 years, if you are a shareholder of McDonald's, you would be up 152%. If you were to include and reinvest those dividends, you would be up marginally higher, making it over the last 10 years roughly in line with the performance of the S&P 500. Now, dividend safety, a score of 77, so it does look to be safe. They in fact increased their dividend last October, 9.9%, a lot better than that minimum 4% inflationary target that we do like to see on this channel. Now, in terms of the valuation of McDonald's and what we typically do when we do our deep dives for each one of these companies, we do run through every single one of these models. Today, we're getting straight into that intrinsic value, and what we are arriving at today, $298. As we can see, that current price does sit just below $250. As always, we start off with our 10% margin of safety. We execute if it meets our 3 criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that for McDonald's, what it is a buy at $268, then we keep going till it's near the current trading price. And what we can see, if you are looking for a 20% margin of safety, you will have to wait for $238. Although in today's episode, we do clearly see at least a 15% MOS level. In terms of Wall Street, well, they actually see more upside than our intrinsic value. They have a price target of $311 over the next year, and they see 24% upside, indicating this as a clear buy for the portfolio. Now, before we move to the next one, just to let you know, we have released our latest free weekly article where we run through some strong dividend growth stocks and our own price targets for which we will purchase them. If you want access to this or any others, it is all completely free, and you can click on the pinned comment to start reading straight away. The next one we're looking at is Starbucks. Again, a mixture of very poor earnings as well as the boycotts. We can see it trading towards its 52-week lows. We do get a double buy rating, Seeking Alpha and Wall Street, although we do note a hold from Quant. Forward yield, we're pretty much touching that 3% level and marginally lower than the S&P. Over the last 12 months, as we mentioned, down 22%. If you've been a shareholder over the last 10 years, you would be up 96%. You would have underperformed the S&P from that same time. And we can in fact see all-time highs, $126. We're talking about 3 years ago. In terms of dividend safety, well, they were recently downgraded after their earnings call. They now sit at 60, borderline safe. And this is a dividend growth company. We have seen historically nice increases, 7.5% in the latest September 23. So in terms of the valuation, as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified. We do get to just under $101. So margin of safety, we do see quite a nice number for Starbucks today, 15% around $86, 20% still looking like a nice 20% reasonable MOS at $81. If you want 25%, well, you may not have to look too much further if it does drop a little bit in today's market. So right now for Starbucks, you are getting a 20% margin of safety. In terms of Wall Street and their predictions, well, they see a price target under our intrinsic value over the next year, $95, but that does still indicate nice upside of 23%. We then move on to Intel, very poor recently, although it does get a 1 buy rating from Seeking Alpha, a double hold from the other two. Trading at its 52-week low with a forward yield given it was cut not too long ago at 1.62% and a forward P that does sit pretty high at 28, above the S&P and above the sector median. Over the last 12 months, well, it is down just over 8%. over the last 10 years, pretty much flat. So even if you weren't to reinvest those dividends, that is a very poor return. If you include inflation, you would have lost a lot of purchasing power and in fact, over that period, taken a massive pay cut. In terms of dividend safety, well, another borderline safe score. It does sit at 50, as we can clearly see, and we are still now waiting on a dividend growth after the fact that they did not too long ago cut that dividend. So in terms of the valuation for Intel, and don't forget, for these models, you can grab a copy below running your own numbers through, whether it's these companies or companies of your own. So current price at just over $30. We do see an intrinsic value at $35.77. 10% MOS will buy at $32.20. 15% pretty much at that current trading price. If you are happy with that level, then it does indicate a buy. In terms of Wall Street, well, they actually believe this to be the opposite of the other two. They have a higher forecast than our intrinsic value. They see upside of 30% for this semiconductor company. We then move on to Deere Company, where we get a double buy and a hold from Quant. This is a cyclical company, so bear that in mind. Over the last 12 months, they are down 8%. Over the last 10 years, we can see up 308% and an outperformer of the S&P. In terms of forward yield, well, 1.63%. In terms of forward P, 14.21. Nice to note, first one today, a very safe dividend score of 83. They also do increase that dividend at a very rapid rate, 16% just over the last full year for DE. So in terms of that intrinsic value, then today it is the average of just the two models, getting to $442. Current price, well, $360. 10% margin of safety, a buy at $398. 15% at $376. And at 20%, we can see it isn't there yet. Not too long to go if it does continue its downward trend over the last few months. But what we can see, at least a 15% margin of safety. In terms of Wall Street, well, their price target lower than our intrinsic value. They do see upside of 18%, and their price target is $425. We then move on to Mondelez, where we have our first strong buy rating, and it is from Wall Street, a buy from Seeking Alpha and a hold from Quant. Now, this is down over the last 12 months, 11%, very similar to the likes of Hershey's, where they have struggled with the increase in those cocoa prices. Over the last 10 years, though, you would be up 72%. Again, an underperformer of the S&P, trading to mid to lower end of the 52-week range, with a forward yield of 2.61% and a forward P just under 19. We have a safe score, 66 in fact, and they did last summer increase that dividend by 10%, indicating for Mondelez, ticker symbol MDLS, we are anticipating a dividend increase over the next few days. So in terms of the essential valuation for this, remember Wall Street do indicate this as a strong buy. We arrive at $78. So a nice margin of safety depending on what you're looking at. 10% indicating a buy at $70. 15% pretty much a buy now if that is sufficient for your investment strategy. In terms of 20%, well, you would need to wait some time at $62 if that opportunity did arise. Right now though, 15% margin of safety. In terms of Wall Street and their price target, $81, upside of 25%, more bullish than us in terms of the intrinsic value. They do say a strong buy, definitely one for the portfolio. Let us know though your thoughts below. We then move on to NOC, and what we do note, a double buy, although Wall Street do be the one who do say hold. We can see towards the lower end of the 52-week range, 1.9% forward yield and a forward P 17.5. Down 5% over the last 12 months. Over the last 10 years, nice performance, plus 261%, outperforming the S&P. On top of that, we do get a very safe dividend score of 90, and just last month, they did in fact increase that dividend by 10%. Always love to see double-digit increases. So the intrinsic value for NOC, we do get a price of $507, and we can see some way away from the current trading price. 10% then a buy at $457. 15% $431, not too far off, just a few dollars, so it is inching towards that 15% margin of safety. In terms of Wall Street, well, they have a price target not dissimilar from our intrinsic value, with 17% upside over the next year. We then move on to what I would say is a high quality company, Old Dominion Freight Line. We just have one buy from Seeking Alpha, a double hold. It is towards the lower end of the 52-week range, with a forward yield of 0.58%, although they do increase that dividend at a rapid rate. Forward P just above 30, down 3% over the last 12 months. Over the last 10 years, phenomenal performance, plus 721%. Now, they do have a very safe dividend score at 81, and they did also increase that dividend 30% at the beginning of this year. So it is a high quality company. When we have done our deep dives, a lot of the metrics are very, very strong. and we do get an intrinsic value of $202 today. In terms of a 10% margin of safety, well, a buy up to $182. 15% you would have to wait for around 171, and it actually wasn't there not too long ago. So 10% MOS in terms of Wall Street, well, they see a price target of just under $200. Again, not dissimilar from our intrinsic value, upside of 12%. We then move on to MSCI, where we actually get our first sell rating from Quant. However, the other two analysts are indicating a buy. It is trading in the mid to lower end of the 52-week range with a forward yield of 1.34%, forward PE just under 33. Over the last year, well, marginal growth plus 1%. Over the last 10 years, very, very strong performance, up 940%, and we can see all-time highs around the $665 mark, again, nearly 3 years ago. Dividend safety, well, 61, it does look to be safe, and they did increase their dividends similar to ODFL at the beginning of the year, nice 16% to note as well. So this is also a high quality company, especially if you do believe this in the longer term. Historical performance have also shown outperformance. Intrinsic value then, $589. MOS level, well, 10%, a buy at $530, 15% around $501. And at 20%, it is indicating a few dollars more and it will reach that level. So today's episode, 15 to 20% based on our estimates and judgments. And as always, if you want to see those, you can take a look at our deeper dive. Wall Street then, $568 price target. In terms of upside, 19%. And they do see it lower than what we have calculated as our intrinsic value. We then move on to a company that has been beaten down horribly. It is Estée Lauder. Now they are down 47% over the last 12 months. Over the last 10 years, marginal growth of 42%, and we can see all-time high $370, nearly 4 times the current trading price. Since then, though, it has started to come down. Right there at its 52-week low, we essentially have a pick and mix. We have a buy for Wall Street, a hold from Seeking Alpha, and a sell from Quant. In terms of the yield, well, 2.5, and the forward PE does sit very high at 47. Now, in terms of dividend safety score, well, 60, borderline safe, and they haven't increased that dividend since November 2022. So what does the valuation look like for EL? Well, today's episode, it is looking pretty strong at $138, considering that trading price today. So margin of safety will be very strong. 10% a buy at 125, 15% at 118, and at 20% it is still looking at a buy. Again, this does depend on if you do believe the long term of these companies. 25% then we can see pretty much there or thereabouts, which is very large for this company. And in terms of Wall Street, well, they do have a mammoth of upside, 45%, $153. As always, though, do let us know your thoughts if any of these you would like to see a deeper dive. We then move on to General Mills, where we have one buy rating and a double hold. Again, trading towards its 52-week lows, also down in the pre-market. Forward yield, 3.8%. Forward PE, just under 14. Over the last 12 months, well, down 18%. Over the last 10 years, not the greatest. It is up 19% only, although we can see it come down significantly from all-time highs last year at $91. We do, however, get a very safe dividend score of 90, but do note they did have a mediocre increase to the dividend, 1.7% just last month. Also remember, you can grab a copy of this model by clicking on the pinned comment below, running your own numbers through as well. So in terms of the intrinsic value at $73, the current price at $63, a 10% margin of safety would be a buy at $65. At 15%, not that far, around $1 shy, so we can say 15% MOS level. In terms of Wall Street, well, they see the share price at just under $70, so 11% upside. As always, let us know your thoughts about these 10 dividend stocks at their 52-week lows, whether you're adding to any, maybe on the watch list, or maybe for whatever reason, they're not something you're considering for your own strategy. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and we'll see you all on the next one.